January 26th, 2026. The vaults are empty, not metaphorically empty, not slightly depleted. Actually, physically, structurally empty in a way that should terrify anyone holding paper promises instead of metal. 33 million ounces vanished from COMEX warehouses in 7 days. 7 days. That represents 26% of registered inventory disappearing into private hands during a single week in early January. This is not normal market behavior. This is not profit-taking. This is a run. A quiet, methodical, institutional bank run on the physical silver system that has underpinned global industrial civilization for decades. Silver closed this past week above $92 per ounce. 1 year ago, it traded at $31. That is not a rally. That is a repricing. That is the market screaming that something fundamental has broken in the architecture of global commodity flows. When Citigroup projects $110 by the second half of this year, they are not being bold. They are being conservative. They are acknowledging what the physical market already knows. The paper price and the real price have diverged so catastrophically that one of them must collapse. This brings us to the most dangerous signal in the entire financial system right now, one that almost nobody outside of bullion banking understands. Silver lease rates exploded to 8% annualized in January. 8%. In a normal functioning market, you pay perhaps 0.5% to borrow silver for 30 days. When that rate jumps to 8%, it means something existential. There is no silver to borrow. Counterparties are so desperate to secure physical delivery, they will pay 160 times the normal rate just to guarantee settlement. Think about what that means psychologically. It means trust in paper contracts has evaporated. It means the entities that run the COMEX and LBMA systems can no longer credibly promise delivery. It means we are watching the final days of a Ponzi scheme built on 356 paper claims for every physical ounce. Now we need to talk about what actually caused this. Because this is not about industrial demand, though solar panels and electric vehicles consume 700 million ounces annually. This is not about investment inflows, though silver ETFs absorbed $2.57 billion in the past year. This is about something more fundamental. The Chinese Communist Party decided silver is now a strategic asset, placed it in the same classification as rare earth elements, and on January 1st of this year cut off 60 to 70% of global refined silver supply from Western markets. 44 Chinese companies received export licenses. 44. Out of hundreds that previously shipped metal freely. The licensing requirements are designed to exclude everyone except state-controlled giants. 80 tons of annual production capacity minimum, $30 million in credit facilities, and direct government approval for every shipment. Do you understand what Beijing just did? They looked at the global electronics supply chain, the solar industry, the defense sector, the entire Western industrial complex that runs on silver solders and conductive pastes, and they said, you no longer control access to the metal that makes your technology possible. This is the rare earth playbook applied to silver. This is economic warfare conducted through export controls. And it worked instantly. Physical silver in Shanghai now trades above $80 per ounce, while COMEX futures remain suppressed in the mid-30s. The arbitrage is $50 per ounce, $50 of pure profit for anyone who can extract metal from New York and ship it to Asia. Except they cannot extract metal from New York, because there is no metal left to extract. Registered COMEX inventories have collapsed 70% since 2020. London vaults have lost 40% of holdings. Shanghai stockpiles hit decade lows. The entire visible global inventory of good delivery silver bars now represents less than 45 days of industrial consumption. This is where the system breaks, because silver is not like gold. 75% of annual silver production comes as a byproduct of copper, zinc, and lead mining. That means higher silver prices cannot stimulate new supply. You do not open a silver mine when silver hits $100 per ounce. If the copper price does not justify operating the mine in the first place, supply is structurally inelastic. It peaked in 2016 at 900 million ounces. This year, production will barely reach 835 million ounces. Meanwhile, demand sits at 1.2 billion ounces. The math is simple and brutal. The market needs 300 million ounces that do not exist. And China just removed the mechanism that was papering over that deficit. The global confirmation is visible in price premiums that should not exist in efficient markets. In Dubai, physical silver coins trade at $99 per ounce, while COMEX futures, quote, $72. That is a $27 premium, a 37% markup over the so-called official price. In Japan, secondary market premiums hit 60% during supply squeezes. 60%. These are not transaction fees. These are desperation premiums paid by buyers who understand that paper contracts will not deliver and that time itself has become the enemy. When you hold a futures contract, Settlement takes days. When physical supply is this tight, prices can move $10 in those days. The carrying cost of uncertainty has exploded. Now we need to examine the lagging asset, the contradiction that reveals the true nature of what is happening. Bitcoin sits at $87,000, up 150% year over year, recovering from corrections with hash rates at record highs. Gold trades above $5,000 per ounce, up 85% in 12 months. Silver surged 234%. But the dollar index collapsed 9.5% to 98. U.S. Treasury yields dropped below 4%. Inflation officially measures 2.7%. According to every traditional model, this should not be possible. When inflation is contained and interest rates normalize, speculative assets should decline. Instead, they are exploding. Why? Because the market no longer believes the official numbers. Because market participants understand that when central banks cut rates while deficits remain at wartime levels, the currency itself is being debased. Assets are not rising. The measuring stick is dying. This is the contradiction that silver exposes most violently. Because unlike gold, which is pure monetary metal, and unlike Bitcoin, which is pure digital speculation, silver occupies both worlds simultaneously. It is industrial necessity and monetary refuge. It is consumed and hoarded. It must clear physical delivery for factories while also serving as inflation protection for investors. That dual identity means silver cannot hide behind paper abstractions the way gold sometimes can. When the vaults are empty, industrial users face production shutdowns. When Shanghai premiums blow out to $50 discounts versus COMEX, refiners face bankruptcy if they honored paper contracts. The system is forced to choose: deliver metal and cease operations, or default on contracts and destroy trust. Both options are catastrophic. The final verdict is this: we are witnessing regime change in commodity markets. The 40-year period of globalized supply chains, fungible inventory, and reliable arbitrage is over. What replaces it is a fragmented world where physical possession determines price, where export licenses are geopolitical weapons, and where paper markets become increasingly irrelevant sideshows. Silver at $92 is not expensive. It is the market finally pricing in reality. $110 is not a target. It is a milestone on the way to repricing an asset that has been systematically undervalued for decades through paper manipulation. Holding cash in this environment means losing 8% annually to real inflation while watching hard assets reprice upward by triple digits. The opportunity cost is staggering, but more than that, time itself has become hostile to paper positions. Futures rollover dates, settlement delays, vault availability, export licensing timeframes. Every friction point in the paper system is now a point of failure. The speed at which physical silver moves from available to allocated, from vault to buyer, from west to east, exceeds the speed at which financial contracts can adjust. You're not betting on price direction anymore. You're betting on delivery. And delivery is no longer guaranteed. This is not a prediction. This is observation of a system breaking in real time. The vaults are empty. The Chinese control supply. Industrial users are panic buying. Investment flows are accelerating. Lease rates signal absolute scarcity. Paper physical spreads have blown out to levels that destroy arbitrage profitability. And every attempt to restore order through margin hikes, contract changes, or regulatory pressure just accelerates the flight from paper into physical. The market is telling you the truth. Whether you listen is your decision. But understand, doing nothing is itself a decision. It is a decision to trust paper promises in a world where paper is being actively repudiated by those who hold the metal. The regime has changed. The question is whether you change with it or get swept away when the final reckoning comes.